Introduction to Strategic Cost Management. Again, a fully theory based chapter. Now, what are we going to learn first in this chapter? Let me first give a broad overview of the chapter. First, you are going to learn what is traditional cost management and what is strategic cost management. So, earlier the paper name was called Advanced Management Accounting. That is technically called as a traditional cost management approach. We'll discuss a little bit in detail about this, but first area is going to focus on traditional cost management versus strategic cost management. What are the key differences between them? Which approach is better? When should you follow which approach? So that's the first area you're going to do. You will also talk about certain strategies in this chapter. You could have come across two strategies at inter level in strategic management. Organizations follow a cost leadership strategy and a product differentiation strategy. So something on those points will also be learnt as part of this chapter. What is a cost leadership strategy and what is a product differentiation strategy? Practical examples are well known to you. Product differentiation is your Apple devices, and your cost leadership are most of the other phones which are there in the market. Most of them compete on the cost side. Apple competes on the quality or on the features there. You will also learn about something called as Porter's 5 forces model, because that will help us in analyzing how attractive an industry is. Because what you learn in this chapter is the strategy which you undertake, the strategy which an organization undertakes depends largely also on the external environment. And how do you analyze the external environment? One of the way of analyzing the external environment is Porter's 5 forces model. You could be the best in the industry, but if the industry itself is struggling, you may have to take an exit route from that industry. You will learn about an area called a segmentation analysis. An industry will have multiple segments. So how do you analyze each segment? How do you decide when do you want to enter a segment? For example, at CA classes itself, I may broadly classify the segments as CA Foundation, CA Inter, CA Final, post qualification courses. So we are taking classes for few levels. We may decide to enter another segment if we find it is attractive. We may decide to move out of one segment if we find that that segment is not that attractive. So that's another area which you will see. You will see also something called as a value chain. I'm not very sure if this term was explained to you at strategic management. Maybe you could have got used to this. There's something called as primary activities and support activities of a value chain, again given by Porter. How does an understanding of value chain help an organization to follow its product differentiation strategy and to follow its cost leadership strategy? A link between the product differentiation, cost leadership. There's in fact another strategy called as focused strategy. All this you will learn as we follow this chapter. And finally, I think you will end with understanding what is vision of an organization. What do you mean by vision? What do you mean by mission? What do you mean by objectives? How does goals of an organization gets developed? What are the strategies an organization is going to implement? Okay, first thing we are going to do is understand an area called as traditional cost management and strategic cost management. At CA Inter level, you could have come across the basics of costing. In the first class you would have learned why do you learn costing. In the first class or the wherever you would have gone for classes or when you would have read your first chapter. What do you do in costing at inter level? What is the reason for learning costing? What do you mean by costing, or what is the costing going to really do? Like financial accounting does record keeping, bookkeeping, and finally gives you financial statements. What does your cost accounting do? Yeah. Decision making is the final area. That's the final area of the cost accounting. But what's the crux of cost accounting? Allocating cost. Okay, allocating is that is one part of costing. What else? Evaluating is again related to decision making. So that's the final part. That is one part of the costing, but that's the final part. Okay, that's also okay. Fixing selling price is one part, but how will you fix the selling price? Okay, only based on profits? Cost. So the basic idea of cost accounting was cost ascertainment, cost control, and cost reduction. That is what you could have learnt at CA Inter level, and traditional cost management was just focused on that, understanding how the cost of an organization is. First you will have to calculate the cost of a product or service. That is called cost ascertainment. That will include allocation, which some of you have said. It will include apportionment. Once you calculate the cost, it may be used to calculate the selling price, only may. Practical world, most of the time cost is not used to calculate selling price, because selling price is market driven. Selling price is mostly market driven, but one of the factor can be that you decide your selling price on the basis of cost. After the cost is calculated, some organization may decide to reduce cost. So traditional cost management focus area was this only, understanding what the cost of a product or service is, and see ways of controlling and reducing cost, and gradually move towards an area called as decision making. Decision making is one of the part, I am not saying a no to it, but that was not the major part of traditional cost management. Allocation of cost and overhead, and focus is on cost control and cost reduction. Focus is on cost control and cost reduction. Cost reduction is basically bringing about a permanent reduction in cost. Cost control is sometimes a temporary reduction in cost. It may not be, because I have a budget. For example, we did one question in budgets. There was budget constraint style and there was a profit conscious style. There was an example where there was a machinery breakdown which had happened. Because the machinery had broken down, you had to repair this machinery. Under a budget constraint style, the person was not ready to repair the machinery, because once you repair the machinery, what will happen is you will exceed the cost target. So cost control will ensure that you are always operating within the target which is given. Cost control will ensure that you are operating within the given target. You don't want to exceed the given target. Because you don't want to exceed the given target, you put a temporary control saying let's not spend on maintenance, which may not be a good way of doing business. TCM focuses more on variance analysis. What is variance analysis? Is comparing the actual cost with the standard or budgeted cost, understand why there is a variation and try to take some corrective action. This approach is not going to help in the practical world. So there are a lot of limitations on TCM approach. The limitations are any idea what can be the limitations of TCM? Okay, qualitative factors. Okay, what else? Qualitative factors. Anything else? One point is qualitative factors. Right, wrong doesn't really matter. I want just participation. Okay, not flexible. Understood. Next. Okay, value chain is a technical term, but okay, I am writing it. Okay, ignoring long term benefit are technically called as short term focus. You either ignore the long term benefit is a word you say, or you focus on short term. What else? Okay, I think broadly the points are there. There will be undue focus on your cost side. You will focus more on the cost side. Sometimes this can even come at the expense of quality. So if it comes at the expense of quality, you are gone in the business, because after some time you may not exist. Quality is something which cannot be compromised in any business. Any business, quality compromise happens, there is a high possibility that that business may not survive for a longer period of time. Lot of businesses today are still surviving because they were able to give quality products in the past. Now there is a quality deterioration. If there is a quality deterioration which has happened now, customer may wait for some more time, but if they see a permanent decline in quality, customers will move away from that product. So somewhere the focus on quality, cost reduction at the expense of quality reduction, cost reduction at the expense of quality reduction. You are somewhere going to compromise on the, you are going to compromise on the quality of the product so that your costs are in check. You don't want to compromise on the cost side. Because of that extra focus on the cost side, somewhere the quality may get eliminated. The quality focus can be not there. Some of you talked about this short term outlook. It has a focus only for short term period. It does not. That quality reduction is basically this point only. Short term outlook is basically this. Your budget constraint style did say that there will be too much focus on the short term performance. When you focus on the short term, it can even come at the expense of the quality, even come at the expense of the another issue is, the point is not there. Under this approach, you will be paying too much focus on your accounting data. This point is not there, but you will be paying too much focus on the accounting data which is there. Why do you focus too much on the accounting data is, you feel that accounting data captures everything which is happening in the company, but accounting data normally gives only a backward view. It does not give you a forward view. It is not going to help you in exactly taking a call on the future strategy. It normally has a back end view. It doesn't have a forward view. When it doesn't have a forward view, what will unfortunately happen is, you are going to ignore all your external factors and follow a reactive approach. You are going to ignore all your external factors. You are not bothered about competition, you are not bothered about market growth, you are not bothered about customer requirement, you are least bothered about all of them. You somehow feel that you know everything, So because of this, what will happen in the end is, you will start compromising on quality, and because of this, it can lead to a lot of challenges for the company. Some of the example: preventive maintenance versus breakdown maintenance. I don't want to do preventive maintenance because I feel it's extra expenditure. Preventive maintenance is an extra expenditure. I don't want to do this preventive maintenance. But if you feel that's an extra expenditure, that's an unnecessary headache for the company. It's not an extra expenditure for the company. Next point is decision on closure of service center. Now, when I am evaluating this decision, can you tell me what challenge can happen? What is decision on closure of service center? What factors may get missed out in traditional analysis? No, not on the going concern. I have some 100 service centers. I am planning to close one service center. I am just planning to close one service center. 100 will become 99. That one service center closure is because the cost is on the higher side. So I am planning to close it. But I am not focusing on few points there. When I am trying to close a service center, why I am closing the service center is, there are extra cost. 100 stores, cost is 100 crores. I want to make it 95. My cost will become 95 crore. When you reduce the number of service center, who can get impacted? Customers can get impacted. Earlier, a service center was in the radius of 3 km for me. Now a service center could be in the radius of 5-6 km. So customers can get impacted. Employees may also get impacted. Somewhere you are not going to think on all of this. Just go by financial analysis and then say, please close the service center. These customers who are there can move to some other place. So that's the approach of TCM. TCM focuses, there is undue focus on cost. There's too much focus on cost as far as TCM. Next comes strategic cost management. Any idea what is strategic cost management? What are you going to do in this? What will be the focus? Here the focus is cost control and cost reduction. Okay, concentrate more on qualitative factors. Okay, what else? Okay, not focus on cost. Okay, ठीक है. What else? Okay, understood. So what else? What is going to happen because of all of this? Your points are all perfect, but what is going to happen because of all of this? Cost allocation will be correct. We are not even focused on cost allocation. We are not really bothered about it, but yeah, cost allocation will be proper because we will follow activity based costing there, but we are not really bothered about the cost allocation side itself. See, you said we will not focus on cost, we will focus on qualitative factor. All that is fine. What is this finally going to lead to? So long-term benefit means of what? Okay, sustenance. Finally, it leads to something called as improvement of strategic position of a business. That's the technical name, or indirectly you can say it enhances the competitive advantage of a company. It enhances the competitive advantage of a company. I want to be having better performance as compared to others in the industry. Strategic position of a business focuses on improving the strategic position of a business as well as improve cost. Cost is not ignored here. Cost is not ignored. You cannot ignore cost in any kind of scenario. Cost is something which is going to be focused on, but somewhere the focus will be to improve the strategic position. How do you improve the strategic position? Either through cost leadership or your product differentiation. Either go through the cost leadership technique or go through the product differentiation technique. So the focus here is on qualitative factor, focus here is on long term scenario, focus here is on quality of a product, focus here is on better allocation. All that is there, but finally it has to ultimately lead to, for example, what is improved strategic position for Bharadwaj Institute is, earlier if you were asking 10 students, 5 were selecting Bharadwaj. Now if 7, 8 select Bharadwaj, then our strategic position has improved in the market. People will have to choose us. It could be because we cover syllabus on time, we are able to complete everything. It could be because of product differentiation. It could be because our class fees is on the lower side. It could be because of cost leadership. It could be any of them. India is predominantly a cost conscious market. Many industries, cost leadership will only work. Education is a sector where cost leadership may not work that much because there are a lot of other things which go into it. So here cost leadership is not going to fully work, because even if I make my classes, let's assume at 1000 rupees, still I may not get more registration if quality is of a question mark. If quality is maintained, even if I increase my fees, I'll still be able to get the same number of students. So quality is something which is focused on as far as this industry is concerned. There could be some other industry where you would want the cost to be under check. So your competitive advantage can come either through cost leadership or it can come through product differentiation. Now this SCM will somewhere also help an organization to implement these 4 stages of strategic management. What is stages of strategic management is anything you want to implement, I had discussed, I think in one of the question, we were planning to implement something. Okay, in the theory, if you are planning to implement beyond budgeting, what are the points you need to keep in mind, or what are the steps an organization has to do? Always there is a pre-implementation stage, there's an implementation stage, and there's a post-implementation stage. Anything an organization does, pre-implementation. Any idea what will happen in the pre-implementation? What will you do in the pre-implementation? Or for whatever, for example, ICI is coming out with a new syllabus now. So pre-implementing this syllabus, they would have done certain things. They would have done certain things before implementing this. So what are the pre-implementation things they would have done? Sorry? Analyzing the current situation. Okay. Determine what you want to achieve. So basically what ICI ended up doing is more or less this. They wanted to understand what the stakeholders want. Different stakeholders are there. What students want, what practicing firms want, what the industry wants, because at this stage students' need were also kept in mind, also the industry need was kept in mind, because understanding what exactly they were needing. So they did that planning exercise, and planning exercise can go for a longer period of time. There could be talk on the syllabus, could be even for a year or so. They would have done all that planning exercise. Most of the subjects, the study material could be in final stages of preparation also. They could have reached even the advanced stages of preparation also, because moment they release, they say this, they may have to come out with the new material and all. So there was a pre-implementation stage. So organization will try to understand why do you want to implement something, and planning, and sometimes a communication needs to go to the people. A communication needs to go to the people as to what we are planning to do, how we are planning to do. Any change happens in an organization. I have seen some changes happening in the place I used to work, the way we were delivering something. So I used to work in a rating agency, so we used to write something called as a rating note. So there was earlier a different approach, then the approach underwent a change. When the approach underwent a change, I was part of the planning team. So I know the amount of time we spent on the planning. Then there were continuous training sessions. There could have been at least every week one training session was there. So people used to attend, people used to come with new challenges. Whenever you implement something, there will be so many challenges. You may have seen this in the practical world also. When the GST website, I'm not sure if still there are challenges there, or the income tax website, because there are challenges which keep coming in. They keep making those adjustments to that. New challenges come, new adjustments come. So there is always a post implementation control which is needed. So formulation of policy, you formulate exactly what you want to do. then communicate this to the employee. These two are technically part of the pre-implementation stage. Formulation and communication is part of the pre-implementation stage. Then you implement, and then there is a control mechanism which comes in. Now in the side you can write, whenever you are trying to implement anything, there are few things which are needed for any technique. For example, if you are planning to implement Six Sigma, you are planning to implement budgetary control, you are planning to implement anything, there is a need for few points which are needed for any of the technique. Some of them can be different. One, top management support. Commitment or top management support is very critical. Any technique you want to implement, anything you want to implement, it cannot be implemented without top management support. Many techniques also talk about this. TEI. TEI is total employee involvement. Total employee involvement. I want all employees to somewhere participate in this. When I say participate, it need not be participation in the planning process. It could be participation in the execution process. You will execute it and say that these are the challenges you are facing. Training. This could be one of the need in most of the technique. Training could be one of the requirement in most of the techniques which we are going to implement. Proper documentation. This is also very critical. Proper documentation. See, irrespective of how many ever things you are going to learn, it will say that we want to remove wasteful activity, everything will be talked about. Documentation is never treated as a wasteful activity in any of the technique. Any of the technique does not think documentation to be a waste activity. Even in your audit firm, the documentation which you do may not help you at that point of time, maybe, but you know what can happen. Suddenly some issues happen, the first thing you will have to look up to is your documentation which has been prepared, and many organizations would be very clear on that. There can't be any compromise on the documentation front. Now why do I need SCM? Why do I need SCM? So one, all those limitations would be removed, but SCM is going to improve my competitive advantage. It will also help me in somewhere implementing this 4 stages of strategic management. These 4 stages: sustainable competitive advantage through cost leadership or product differentiation, can also help in implementing 4 stages of strategic management. The 4 stages of strategic management can be implemented with this. Okay, the points are going to be more or less self-explanatory. You can go through it. Because whatever limitations I talked about, this is what is going to be there here. Short term focus, long term focus, internal focus, internal plus external focus, single cost driver. This was your traditional costing. You would have learnt overheads, 2 types of overheads chapter. One is absorption costing method and second activity based costing method. Under ABC you will have a separate cost driver for every activity. TCM focuses getting to know what is the problem and solve the problem. That is more of a reactive approach. Here you go with a proactive approach where your focus is more on cost leadership or product differentiation. Any doubts on this? Components of SCM will not cover, we'll just spend maybe another 10-12 minutes on the initial theory part, and then I go to a problem based area. So now I come to components of strategic cost management. What are the things which you have to learn as part of strategic cost management? One is strategic positioning analysis. What is strategic positioning analysis is, you need to decide whether you want to implement a strategy of cost leadership or product differentiation. We'll discuss a little bit. Cost driver analysis is, cost driver is basically something which causes a cost to take place. Any cost an organization incurs, there are certain drivers for the cost. Example, rent cost is driven by area square feet. Electricity cost is driven by the number of light points. Canteen expenses is driven by number of employees. These cost drivers are of two types. One is called structural cost drivers and second is called executional cost drivers. We'll discuss them later. Last is value chain analysis, which I was trying to indicate now. In that, let's first analyze what is strategic positioning analysis. What is strategic positioning analysis is basically trying to answer what kind of value you have in the industry. What kind of value you have in this industry. Every company has something unique, so what kind of value does an organization bring within the industry, or what is the relative importance within the industry? Can you give me some examples of product differentiation strategy? What are the companies which are following? One, Apple I had told. Anything else comes to your mind? Product differentiation, something where you are least bothered about the price when you buy a product. Tesla, okay, done. Your entire luxury segment on the car side, entire luxury segment, there the focus is more on the brand value and not the focus on the cost side. Your focus is nowhere on the cost side. Most of the luxury products which you buy, the focus could be more on the brand value, and not even the luxury products, even day-to-day use products. Certain people would not want to compromise on few things, even like a shampoo. So if you are using a particular brand, even if the prices are increased for that particular brand, or if that brand has a higher pricing as compared to others in the industry, you may decide not to compromise on even something like that. So it could be even a garment which you buy, the shirts, the trousers which you buy. So different people have different expectation. India as a market is more driven by your cost side, but there are still certain things where the quality plays a part. So an organization can have a strategy of product differentiation, can also have a strategy of cost leadership. Analyzing the company's relative position within an industry for its performance, it reflects the kind of value a company will create, and how it will be different from rivals. To give an example, something which worked really well for Bharadwaj Institute, I think we started giving the backup videos to students from 2018 or something. At that time, no one in the industry was doing, they were just face-to-face classes. Somewhere we felt that student find that as an extra add-on and it was beneficial for the student. So we somewhere were getting a value because of that point which we were trying to do, giving backup videos to the students. Later on, it also led to some challenges because because backup videos are there, they started missing out on the live classes or the physical. So there are challenges which will keep coming in. We are also trying to see what we can do. But the value at that point of time was because of that. Then later on we ensured that we will cover full syllabus on a timely basis. Covering full syllabus on a timely basis is something which is a minimum expectation, but there were still academies which were not completing it. We could find that. So somewhere we felt that if we try to do even a basic thing properly, it could add value to the end customer. Now this cost leadership strategy or the product differentiation strategy can be of two types. It can be overall cost leadership, it can be focused cost leadership. It can be overall product differentiation, it can be focused product differentiation. So you may want to write this, I don't think so it's covered in that point. The theory which is there, it could be of two types. The strategy could be of two types. One is overall, or second it could be a focused one. Now what is focused and what is overall? My focused strategy is, I am going to take students only from CBSE stream. That's something I'm just introducing. I'm going to take students only from CBSE stream. I'm going to take students who have secured more than XX percentage of marks in their exam, and I'm going to only focus on these set of students. I'm not going to cater to the other students in the market. I'm going to cater to the other students in the market. That's my strategy. I decided that I will focus only on these category of student. I am coming out to the product. My focus of this product is to only cater to kids who are below 2 years. The product which I am manufacturing, I am going to cater to kids who are below 2 years, and that also only Chennai market. Only Chennai market. I am not going to do beyond Chennai. I am not going to do beyond Chennai. So my focused strategy is on this. In the focused also, I may sell my product on the basis of brand strength. I may sell my product on the basis of lower cost. So there can be a focused cost leadership. There can be a focused product differentiation. The other approaches, I am going to cater to the entire market. I am not going to restrict myself to few set of students. I am going to restrict myself to only kids below 2 years. Somebody may even go to the extent saying that kids below 2 years, in that the product could be useful for both the boy baby and girl baby, but I want to just focus on the boy segment. That's something an organization may decide. That's up to them. If they want to decide saying that I'll focus only on the boy segment or on the girl baby segment, so something the organization can decide, and they want to focus only on that. Focused strategy will be very useful for those organizations which are not of large scale. If you are not of large scale, you may decide to implement a focused strategy. When you are at a focused strategy, there is a specialization which is there, and the customer will be able to easily understand the value which you are providing to them. On the overall side, you are not bothered about just catering to one segment. You are now trying to cater to the entire segment in the market. You are not focusing yourself saying that I will just focus on this segment or I will focus on that segment. In both the segments, either you compete on the basis of cost or you compete on the basis of quality. Cost driver analysis. There are some two types of cost drivers. I will come to that in some time. Any idea what is a cost driver? What is a cost driver? One which, okay, one which is the reason behind any cost, okay, based on which the cost can be allocated, okay, basically factor which influences the cost. Reliance Industries manufactures a product. They manufacture it at 5 rupees per unit. Same product I am also manufacturing, but it cost me 9 rupees per unit. Same product, there is no difference in the product. They are able to do it at 5 rupees per unit. I am taking 9 rupees per unit. Why should there be a difference in this? Or what could be the reason? Economies of scale. Okay, what else? Economies of scale. Their R&D facilities could be better. They could be in the industry for a longer period of time. But Reliance Industries Limited cost is going to be very low as compared to my own costing. Cost driver is something which influences a cost to take place. There are two types of cost driver: structural cost driver and executional cost driver. Structural cost drivers are those which have long-term effect. Reliance Industries has a better scale of operation as compared to myself. So because of that, their costing is on the lesser side. They have better experience. They are there in the industry for a longer period of time. Their technology could be better than what I am doing. Complexity depends on the complexity of the product or the complexity of the production process. More the complexity, it can have an impact on the cost. So these are structural factors. This will have a longer impact. And there are some operational decisions which I take which have a shorter impact. If I want to cut down my cost and reach the level of Reliance Industries, it's not going to be that simple, and it will take a longer time. Till they have the scale benefit or the experience benefit or the technology benefit or the complexity benefit, I am not in a position to compete with them. In order to compete with them, it will take me time. It is going to take amount of time. There are certain things which have short-term effect. Workforce involvement. How involved is my employee force in ensuring that the cost come down? These factors can change in the short run. short run. There are changes which can happen to these factors within the short run. Design of production process, efficiency, importance of TQM, supply relationships, all this can undergo changes within the short run, and because of the short run changes which is going to happen, the benefit or the disadvantage which I have can get, the benefit can go away, or the disadvantage which I have, that can also go away in a short term period, in a short period. The most important is an organization increasingly focusing on these four factors: scale, experience, technology and complexity. Reliance Industries Limited and a similar company may compete with each other, but I am trying to compete with them would not really help, because if I try to compete with them, I will not be in a position to compete, and it will unnecessarily lead to extra pressure, because if my competition is Reliance Industries, I cannot survive against them. I should try to compete in places where I can survive. Now let's okay, in the strategic cost management, just give me a minute. There are three parts. One is strategic positioning analysis, which we will discuss little bit again later. Second was the cost driver analysis. Third is value chain analysis. This term value chain is something you may hear it multiple times in the practical world when you are trying to do some business analysis. Any idea what is a value chain? You could have come across this in strategic management also. What is a value chain? Being separated as okay, primary and secondary. Technical names, I don't understand them. Let's assume you have to explain this to your parent. What will you say? What is value chain? If you say primary and secondary, then I'm going to understand anything.
Primary is the manufacturing and secondary is the auxiliary.
Okay.
Value addition not to selling in market.
Value
Addition not to selling in market.
okay, value addition. You made some point, sorry, what is that?
Primary is the core activity.
Sorry? Yeah, please. Sorry, primary is
the core activity.
okay, primary is the core activity. No, but point is primary, secondary, I understand, but first I don't understand what is value chain. You are saying there are primary activity, there are secondary activity, I understood that, but tell me first what is value chain. What do you mean by value chain? Points of value addition, again I don't understand what is value addition. See, I am a layman, you are trying to explain it to a person who doesn't understand technical terms in SCMPE. So if you try to tell me technical terms, I don't understand them. Okay, chain of processes that lead to the okay, that lead to the final product. Okay, chain of processes, more or less closer to the actual definition. Chain of processes that lead to the final product.
With respect to customer perspective, like if any cost which is going to value addition, in order to buying decision.
Okay, customer, from a point of view of a customer point of view, value chain basically refers to set of activities an organization does to ensure the product reaches the end customer. Set of activities an organization does to ensure that the product reaches the end customer. Lot of things would be done by them. We will technically analyze those things which are being done as value adding activities, non value adding activities. We can also analyze this as you were saying, primary activities and support activities. So value chain basically represents those set of activities by which an organization ensures that the product reaches to the end customer. Identify various activities that add value to the end product. Objective is to eliminate non value added activities. In my classes, we initially started with first a physical class was there, then we said we will start giving videos, then we said we will give revision videos, then we said we will give some tests. So some of these activities student doesn't feel that it adds any value. For example, I do some 7-8 things in my class. I give some concept tracker, I give some summary notes, a lot of things I keep giving. Some of them students finally felt it doesn't add value to them. If it doesn't add value to the end customer, your job is to eliminate that activity. Your job is to eliminate that activity. You go to a bank, you want to withdraw money or deposit money. Before withdrawal, deposit, you reach bank, there are a lot of activities which happen. Some of the activities which the banker does If I ask the bank manager, why are you doing this activity, he doesn't have a reason to it. For example, before the money is to be withdrawn, he has to do some checks and balances, some signature, the challan goes to someone approves it. Some of them has a reason. Some of the activities don't add any value and adds up to the waiting time of your end customer. Anything which does not add any value to the end customer, or certain activities may not add value to the end customer, but still you will have to do. For example, filing income tax returns. A company is filing income tax return, it doesn't add value to the end customer mostly. Indirectly it can add value, because if you don't file income tax return, you may have to move out of the business, so your customer cannot reach you. So certain activities may still have to be done by the organization, but the objective is to eliminate non-value added activities, something which does not add any value to the end customer. Okay, there was, I think, 2-3 examples which were there, which I think you may see it in again activity based costing chapter, but I'll give you those example. One of the example was, you are buying a software. In the software, they are giving you an AMC service for which they are not charging anything extra. What is the AMC service going to do is, whenever you face an issue, you can call them, they will sort it out, they will sort out the issue. Now there is a cost incurred for this AMC service. Is this AMC a value added activity or a non-value added activity? Is this AMC a value added activity or a non-value added activity? Does it make any difference to the end customer? Does it make difference to the end customer? If you say yes, then it's a value added activity. If you say no, it's a non-value added activity. Something could be value added for one customer, could be non-value added. We go by majority concept. Mostly AMC service is a value added activity. You may not charge additionally for it, but it would be clubbed together in your base price itself. Okay, you are buying a pencil. In the pencil, you see, when you buy a pencil, there will be a painting on top of the pencil. There will be some different colors, some red color, some grey color, some color would be there. There is a painting which is done. The case study asked that pencil painting which you are doing on top of it, that is, the pencil has a base color. On top of that, there could be some extra color which is added. This painting of pencils, is it a value added activity or a non-value added activity? Value added or non-value added? Value added, non-value. Does it make any difference to the end customer? Think about the users of the pencil and then see. Does it make any difference or no? Recognition of brand. Okay, who are the end users first? Mostly kids. If you give two pencils to them, one painted, another non-painted, which one will they choose? Does it make any difference in writing? No, it doesn't make difference. But still, what will be chosen by them? The painted one. 90% of them will do that. Even if you give me a choice today also, you keep me two pencils, I'll mostly pick that painted one. Doesn't make any difference from a usage point of view. Doesn't make any difference. That extra painting may cost you 10 paise, may cost the company some 10-15 paise, but from my point of view, it makes a difference as an end user. There could be 10-15% who will say it doesn't make any difference to them. There could be a 10-15% who will say it doesn't make any difference to them. I am not bothered about them. Major category will feel that painting makes a difference. It's a value added activity. If that makes a difference, it is a value added activity. When you buy a soft drink, a 2-liter bottle, sometimes you will see a celebrity photo on top of that. A cricketer photo could be there, somebody photo would be there. It doesn't make any difference whether that photo is there or not, but the users, when they are buying, major set of the people can get influenced with that. So if the kids are going along with you, most of the times they will end up buying that product. So lot of things which you may think, see, rational thinking may not work at that. See, painted pencil or non-painted pencil doesn't make any difference from a utility point of view. Even when you are trying to write also, it doesn't make, it's not that it makes it difficult for you to write. Nowhere there is an impact, but still it makes a difference. If it makes even a small difference to your end customer, it's a value added activity. A lot of banks send some happy birthday messages, something. If it makes difference to few category of customer, it's a value added activity. If it doesn't make any difference to any customer, it's a non-value added activity. The rule is very simple. So what does value added is? If it makes difference to your end customer. Value chain analysis will try to analyze all the activities an organization does and try to eliminate your non-value added activity. It can basically include all of this: designing a product, producing it, marketing it, delivering it, supporting it. Supporting is sales and service. Service part. Once your product has reached the end customer, some customer will still have issues, they will come back. So your activities can be broadly categorized into two: primary activities, support activity. What is primary activities? Raw material coming into the company. Raw material coming into the company. That's technically called as, you could have learnt at strategic management. What is it technically called as? Raw material coming inside the company. Do you remember the primary activities? Inbound logistics. Raw material coming inside the company. Inbound logistics. The raw material is converted into a finished product. The raw material is converted into a finished product. What is that activity called? Operation. The name is called operation. Raw material coming into the company, inbound logistics. Second is operation, raw material converted into a finished product. Third, the finished product goes to the customer. Goes to the customer or goes to the place of distribution. That's called outbound logistics. After the product reaches the retail outlet or reaches the end customer, before it has to reach, or if it's a retail outlet, your customer should get to know about it. Your customer should get to know about it. That's called sales and marketing. And after the product is taken by the customer, he may need some service, he may need some issues. So these are your primary activities: inbound logistics, operations, outbound logistics, marketing and sales, and service. Inbound logistics, operations, outbound logistics, marketing and sales, service. Raw material coming into the company, raw material getting converted into a finished product, raw material going out or finished product going out. Customer should know about it, so I'll have to do some marketing, and then finally he may need some support. In order to do this, you need certain activities to be done for all these 5 activities to operate. Raw material coming inside the company is a primary activity, but the process of buying the raw material is a support activity. Process of buying the raw material, this is a classification Porter has done. This is a classification. He felt the core activities are inbound logistics, operations, outbound logistics, marketing and sales, and service. For few industries, procurement, not from a value chain classification point of view, but procurement could be the most important activity. It could be that procurement is the most important activity, because if you buy good quality product in that industry, or ensuring that you are able to buy it at the right price is the most important factor, because prices keep going up or coming down. So procurement could become the most important activity in some company, but procurement is a support activity as far as this is concerned. The support activities: one, I need employees. I need employees to do all these 5 things. Employees, human resource management. Employees need to work on few things. They need machinery, they need laptops, they need certain infrastructure to be arranged. Corporate office should be there, admin office should be there. So there is a infrastructure which is needed. There is a infrastructure which is needed. On the infrastructure, using the infrastructure, human resources will work. They need some assistance also. That assistance can come from technology. That assistance can come from technology. So primary activities are 5 things. The primary activities are 5 things. What are those 5 things? Material coming inside the company, inbound logistics. Material converted into product, operations. Material going out, outbound logistics. Customer getting to know about the product, marketing and sales. Service, which is after the product is produced, you want to, after the product is sold, your customers still have some requirements. In order to do all these 5 activities in a smooth manner, I need employees, which is human resource. What else? You need a good infrastructure, then technology is needed, and procurement of the product needs to happen. Whatever concepts are learnt here, they are mostly useful for your manufacturing companies. Can it be applied for a service oriented company? Yes, but it may not be that relevant. It may not be that relevant. If Bharadwaj Institute wants to do, I'll break my head in understanding what is inbound logistics for us, because I don't have any raw material purchase and all happening, but still I may have to think about something and then bring about. In fact, ICI ended up asking one exam question which was on a service oriented company, and they gave certain activities and wanted them to be classified as primary activities or support activity, or classify it as among the 5 primary activities. Something was there, you will see that question in some time, but some classification was to be done. It was related to, I think, some legal lawyer firm. So how do you classify them as inbound logistics, operations, outbound logistics, marketing, sales and service, but mostly they are useful for manufacturing companies. Now for your value chain analysis, first we will also analyze something called as industry structure analysis. Industry structure analysis was something you have done at inter level. Industry structure analysis is nothing but Porter's 5 forces model. Industry structure analysis is Porter's 5 forces model. Segmentation analysis is linked to an industry structure analysis. An organization would want to do an industry structure analysis in order to analyze the attractiveness of the industry in which they are operating. If we have to make profits, there are multiple aspects which play a part. Aspects like how efficient I am, whether I can become a market leader, all those are very, very critical. But still, it is important to know how attractive the industry is. Maybe if I take some 15 years back, or if I take some 10-15 years back, people were taking photos and printing them. People were taking photos and printing them. So there was an industry, your photo film industry was there, the printing industry, the photo film industry was there, people were selling cameras, everything. Now you will rarely see people taking photos and printing them. So unless you analyze the industry attractiveness, for example, if at this point of time it doesn't make any sense for me to get into an industry which is going to die. There are certain industries which are on the verge of collapse. So certain industries are not able to compete. You will see that these industries or these products may get replaced with newer products. So you will have to see how attractive the industry is. In order to analyze the attractiveness of the industry, there were 5 factors which Porter had indicated about. Can you tell me what are those 5 factors? You should know some of the factors. Bargaining power of, okay, power of customer, this was one factor. Bargaining power of supplier should be second factor. Threat of new entrants, okay. Availability of substitutes. What else? Intensity of existing competition. I think these should be the 5 points. Intensity of existing competition within the current competitive scenario in the industry. Now first thing is bargaining power of customer. Let's analyze each of the factor. You're going to do case studies where you will have to do this. So when I analyze bargaining power of customer, either the bargaining power of customer is high or low. Which is good for an industry? High bargaining power or low bargaining power? You will have to tell me, high bargaining power of customer or low bargaining power of customer? Low bargaining power is better. Now bargaining power of customer is dependent on few factors. Bargaining power of customer is dependent on few factors. For example, when you go and buy a product, your bargaining power is dependent on few factors. For few products you have a better bargaining power, for few products you don't have a better bargaining power. Can you tell me what are the factors which impact bargaining power of customer? Higher number of supplier of what? No. So you are thinking from a customer angle. Let's think from a company angle. From a company angle, what influences the bargaining power of customer? So many suppliers will get into your availability of substitute or intensity of existing competition. From your point of view, what influences your bargaining power with the customer? Okay, quality, demand, what else? Okay, price, I am not getting into that point still. What else? Yeah, so the first factor is large number versus few. If my customer, I manufacture a product and that product will be bought by 3 customers only. I have only 3 customers for that product. So there could be a lot of suppliers and all, but I am trying to sell my product only to 3 customers. So if you have very few customers who are buying in bulk, if you have very few customers who are buying in bulk, then your bargaining power will get impacted. Your bargaining power will get impacted. If there are large number of customers, for example, HUL or PNG, they sell their product, there are large number of customer, everything is fine. But if they are selling their product only through 2 distributors, entire India sales is only through 2 distributors, then these 2 distributors will have a good bargaining power when they do their discussion with HUL or PNG. They can be big companies, but still if there are only few distributors of my product, not the end customer, I am not talking about the end customer, whom I am selling my product. If I am selling my product to very few customers, my bargaining power will get impacted. Bargaining power. Apart from that, as you had said, quality, all those things play a part. Because if I have a quality product, I can negotiate better. Also, one more thing which matters is switching costs. What is switching cost is, if I am buying my product from ABC Limited, if it is easy for me to switch to another supplier, then when I am doing my discussion, I have at the back of my mind that I can easily switch. I will start pushing that guy and say that you will have to supply me at the lowest possible price. I will keep giving a lower price and try to cut down on the price, give unreliable targets on delivery. So all I can, because I will have higher bargaining power if it's easy for me to switch to another supplier. If I cannot switch easily, then when I am doing my discussion, then in that discussion I will think that okay, I cannot negotiate that hard also, because if this guy is not ready to supply, I will have to move to another guy, and when I move to another guy, I may have to incur a one-time huge cost. There is an initial cost. Whenever you are trying to switch supplier, there is an initial cost you may have to incur. So are there extra switching costs which you are going to incur if you are trying to supply? Availability of substitutes, all those points will come into picture. I am not saying a no to it. If you have more suppliers, if you have substitutes, all those indirectly will influence your customer, but they also come as separate points. What majorly influences your bargaining power of customer would be your how many customers you have. Very few customers are large number, and switching cost. I think these are the 2 points should be there. Single buyer versus large number of buyers, high cost versus low cost of switching supplier. High cost versus low cost of switching supplier. Is it easy to switch supplier or not? Okay, next is bargaining power of supplier. First point I am writing large versus few. Whether you have more supplier or whether you have few suppliers, what else will matter? Product? How product differentiation will? Okay, so quality of the supplier indirectly, the product which the supplier is giving, if it's of a, see more or less the points are going to be same as what you see in the top. Bargaining power of customer and bargaining power of supplier may indirectly be the same thing. Large versus few, quality of the supplier, what else?
Availability of the material.
This also is very critical. Availability of raw material. If raw material is in short supply, my supplier will start influencing the terms. The same thing will happen on the bargaining power of customer also. If the product is in short supply, I will start influencing it. I will say, I will not supply the product at 20 rupees. You will have to now buy it at 25, 30, 35. This is what happened during COVID. Your COVID essentials prices were very high at that point of time. Despite supply start keeping pace with it, masks were even sold at some 400 rupees, 300 rupees. But you know the price at which they are getting sold now. So that time, because of the demand for the product, you ended up seeing a huge price increase and you were able to influence the market. So if the raw material is in short supply, that time the COVID essentials were in short supply, because of that you were able to influence and do a higher price. So availability of raw material, whatever factors we are analyzing, we should not analyze it for a specific time period. For some time period, for a month or so, the industry is very attractive. Then again, it's not attractive. Again, it's attractive. It doesn't work that way. You will have to take a overall, a longer term view, maybe a year view or a 2-year view. Because raw material is in shortage for a month, that does not influence the bargaining power. Maybe for that month, 1 month, you are left with no choice. But over the longer run, if the raw material is going to be there, then there will not be an issue. This should be the few points. Few suppliers versus large number of suppliers, importance of raw material, availability of alternate input. Okay, importance of raw material, as you had indicated about quality is one of the point. Another point is how critical is that raw material for me. How critical is that raw material for me? If that raw material is very, very critical, I will have a fear in changing it. I will have a fear in changing the supplier, because if I buy a new raw material and there are quality issues with that, my end product impact will be huge. My end product impact will be huge. Availability of raw material, as we saw, if there is a possibility of alternate input, instead of using this input, can I use some other input? If there is a possibility of using some other input, my bargaining power is better. My bargaining power is better. Threat of new entrants, what influences this? What is going to influence threat of new entrants? Okay, government policies. I was looking for one thing specific. You have, sorry? Capital requirement. Okay. All this is moving to one point I am thinking about. What is that? Government policies, capital requirement. What else? Profitability of the industry. Okay. Cost of entering the market. All this basically, are there any entry restriction? So are there any entry barriers? I cannot suddenly enter into a pharma industry. If I want today, I cannot suddenly say that I want to manufacture a product and a pharma product and get approval and start selling it. It is impossible. It is going to take a lot of time for me to enter into a pharma industry. So are there any entry barriers or not for the industry? The entry barriers can come from government policy. The entry barriers can come from capital requirement. I don't want to enter into, for example, oil exploration. That's an industry I don't want to enter because the capital requirement is very high. But maybe there are no government restriction. Government is okay saying that if you want to do it, we don't have a problem. But I need some 50,000 crores to enter into that industry. Obviously, I don't want to enter into such industry where there are capital requirements. Profitability of the industry can influence my decision to enter. Profitability, if it's very highly profitable, it will influence my decision to enter the industry. But what matters is the entry barrier. What matters is the entry barrier. The entry barrier can also be cost of entering the market. If you want to enter the market and you want to spend a huge amount, you may decide not to enter the industry. You will think that it doesn't make any sense for you to enter this industry because there is a huge cost which needs to be paid. I am not going to get into an industry and compete with Reliance Industries because I don't have the capital availability. I don't have that much money to spend initially, and also there could be some restrictions on the government side also. Certain industries government side restrictions can come, certain industries regulators restrictions will come. So basically, are there any entry level issues or not? If there are no entry barriers in an industry, again trouble. See, the worst scenario is very few customers, switching costs are also not there, very few suppliers, quality of the supplier is also very good, raw material is in short supply, there is no alternate supply, so both the guys are going to dictate terms with me. On top of that, there are no entry barriers. Anybody can enter whenever they want, anybody can enter and exit whenever they want. That's also another trouble for me. Barriers to entry, perceived profitability. Are there any barriers to entry? What matters is if there are barriers to entry, then I may decide not to enter into. I will not be able to enter the industry. There is no decision to be taken. If there are barriers, the barriers can come from men, the barriers can come from material, the barriers can come from machine, the barriers can come from money, the barriers can come from regulatory restrictions also. What about your substitutes? How does this influence? How? What are the points to be considered here? Number of substitutes, high versus low number of substitutes. I think I don't see anything else. We'll see the answer, but I see this is the one important point. If you have higher number of substitutes, again it's a problem for you. If you are in an industry which has higher number of substitute products, again this will indirectly influence your bargaining power of customers, and that will cut down on your demand, cut down on your profitability. Few substitutes versus multiple substitutes. Few substitutes versus multiple substitutes. Focus on building brand and customer loyalty to restrict the threat of substitute. The threat is because of, the point is only one thing, few versus multiple. They are saying you try to build brand and all, customer loyalty and all this is okay, but in a practical world price does play a part. So you try to, there are certain products where you don't want to compromise on the brand, there are certain products where you may want to compromise on the brand. The last part is intensity of existing competition. What are the factors which will influence this? Product differentiation, okay. I'm not sure whether it's right or wrong, I'm writing it, I'll explain. What else? Market? Okay, market leader. When will the competition be very intense in an industry? Okay, number of competitors. There are too many competitors in one industry, but still the competition is not that intense. There's one factor which influences that. What fact? Which one? Sorry? Demand. Demand growth. If demand is growing at 20-25% and capacities are growing at 15-20%, you will not have any problem in that industry. Let there be 1,000 competitors also, because everyone will have their own share. Everyone will have their own share. One important factor which will influence is there a growth in the industry. If an industry is stagnating and you still don't want to, you still want to have a share of that industry, you will try to compete. Also what matters is exit barriers. Like you have entry barriers, there can be some industries which will have exit barriers. What are exit barriers? I have entered into an agreement and that agreement is for another 15 years. This agreement is for another 15 years. The agreement could be with a customer, could be with a supplier, could be for a factory, could be with a regulator. If you have entered into an agreement, you cannot come out of it. You cannot come out of it. So exit barriers can also play a big part. High number of firms versus few firms. The major factor is the growth of the industry. If the industry is growing, I don't have a problem, but if the industry growth is not there, this competition will become a bigger issue. Okay, we had discussed one part of the area which is industry structure analysis. I am going to discuss core competency analysis and segmentation analysis now. Any idea what is core competence? You have come across this word again in strategic management. Unique selling, USP of the company. Okay. Can you give me some examples of core competence? Examples of core competence. Unique selling point is fine. Are the core strength of the company, whatever way you want to call it. What could be the unique selling proposition of PepsiCo? USP of PepsiCo. Sorry? Okay, the formula. What else? Formula leads to branding. What else? Marketing. Okay. Extension of marketing is distribution channel. Distribution channel can also be a core competence. The distribution channel of PepsiCo can be a core competence. What is core competence? Is something which is going to be difficult to copy for the competitors. Something which is difficult for the competitors to copy. It's not that they cannot copy it, but it will be difficult to copy, or even if they try to copy, they will not be in a position to copy it fully. So the core competence of Apple is basically the features in their product which is difficult for others to copy. So core competence is the unique strength of a company. Nokia was a market leader in mobile phone segment. When I got my first phone, at that time Nokia was the market leader. They were the market leader. They would have a share of even 60-70%. At that time smartphones were not there. Nokia did not see that market is slowly moving towards smartphone segment. That change was something which was not seen by them. They did not visualize this change happening. when they did not visualize this change happening, indirectly their core competence was giving a good feature mobile phone, that is lost, because the market requirements have undergone a change. Loss of core competence for any company can prove to be a big disaster. It can prove to be a big disaster. In fact, the company can move even out of the business. They may have to become insolvent, or they may have to move out of the industry, or they may get bought out by other player. So core competency is a unique skill that adds customer value. It is difficult for others to replicate. Something which should be difficult for others to replicate is what is core competence. If everybody can copy it, it's not a core competence. Another example which is given there is Kodak. Kodak is basically, I think 15-20 years back, I had a camera, so we used to take photos, get it printed, and then the photos used to come to us. So that is what was happening some 15-20 years back. But things have changed. Mobile phone came, smartphones came, nobody uses a camera. Even now also, even if you want a camera, you get a digicam only. Nobody uses those films and other things. Kodak was a leader there. Kodak was a leader in the film segment, but now nobody does that. Even the printing part is very, very limited. You don't print a photo. You may print it in case you need some passport size photo or something, but otherwise it is not there. The core competence can come from resources, which is men, material, machine, money, along with technology, and the ability of putting these resources into proper use. Just having resources alone will not help, because a lot of organizations may have resources, but you will have to put these resources into some proper usage. If you are not able to use the resources properly, it will not provide you that core competence, or that unique strength will not be there for the company. Core competence comes from resources, can be tangible: land, building, inventory, machinery, money. In short, men, material, machine, money. Okay, that is the major thing there. Or intangible, which is your technology and brand, and capabilities. You will have to convert this resources into productive use. If you cannot convert the resources into productive use, it will not provide that competitive advantage for the company. Okay, this was the second segment of this analysis. The third segment of the analysis is on the value chain, segmentation. Now, what is segmentation analysis is, every industry which you operate can be split into multiple sub-segments. You can split an industry into multiple sub-segments, and based on the multiple sub-segments, you can decide what you want to do that in that industry. For example, automobile industry. Automobile industry is a very big industry. Maruti is not present in the entire segment of the automobile industry. They are present only maybe in the four-wheeler segment, or they will say that maybe I want to now enter into a two-wheeler segment. I may want to enter into a three-wheeler segment. Even in four-wheeler segment, there are luxury cars, there are mid cars, so there are basic cars. So there are multiple segmentation of the industry. What segment analysis is going to do is, it will help you in analyzing the various segments which are present in an industry, analyze the key characteristics of each of these segments, and based on that you may decide to enter a segment, exit a segment, reconfigure a segment. You may decide to do any of them. You may want to enter a new segment, you may want to exit a segment, you may want to reconfigure an existing segment. So all those decisions can be taken. If you analyze on an overall basis, it will not give you the right perspective. Segmentation analysis will help you in analyzing the core characteristics of the different segments of the industry. For example, education industry, I can be in CA teaching, I can be in NEET, I can be in engineering teaching, I have to decide, I can be into MBA teaching, so I'll have to decide where I want to enter into. I cannot keep having presence across entire segments, because some of the segments my strength is not there. In some of the segments my strength will not be there. So let's not try to fight it out in that segment, and unnecessarily you lose focus. What segmentation analysis will do is, it will give you a better focus. It will give you a better focus. So single industry is basically a collection of different segments. Example, your automobile industry. Segmentation analysis helps you in analyzing the structural characteristics of different segments, help in entering a segment, exiting a segment, reconfiguring a segment. One of the examples they have given is ITC Limited. ITC Limited can do their segmentation on the basis of geography. Geography is south, west, north, east, central. After the segmentation, they'll say let's exit out of east segment, or let's exit out of north segment, let's exit out of south segment. They may decide to exit out of one of the segment, or they may decide to enter into a new segment on the basis of demographics, that is men versus women, or age group less than 10 years, 10 to 20 years, 20 to 40 years, 40 to 60 years. Their products can be sold to different people. So, and they also have multiple products with them. ITC is in presence, has in hospitality, they have presence in tobacco, they have presence in your FMCG products. So they have multiple segments, so they may decide to reconfigure one of these segments, and these are the steps you will do. Identify the segmentation variables and category. What are the variables? Is what are the factors which are impacting that segment? Analyze the segment attractiveness. Identify key success factors. You learn about something called as key success factors, critical success factors, and key performance indicators later on in another chapter. But basic objective is, instead of analyzing the industry on a whole, your Porter's 5 forces model said you to analyze the industry. So when you analyze the industry as a whole, you may also have to analyze multiple segments of the industry. The multiple segments of the industry will help you in giving a better focused promotion. It will help you in reconfiguring your value chain. You may decide to exit some of the segments, you may decide to enter some of the segments, and you will have a better profitability and better customer reach, because you are now focused on some of the segments where your unique strength lies, rather than being present across the entire value chain. Now, so next area in your material is superior performance and competitive advantage. Superior performance and competitive advantage. Okay, what is superior performance and competitive advantages? A superior performance is basically performing better than your competitors. The better performance can be on the basis of quality, can be on the basis of price, can be on the basis of delivery, can be on the basis of support. The two primary factors are the two ways we divide this superior performances. We go through one approach called as quality, and the second approach is through the price. So profitability improves with superior performance, which leads to wealth maximization. A superior performance is one which will lead to competitive advantage for the company, and that competitive advantage was coming through two strategies, which were your product differentiation and cost leadership. In the product differentiation, we learnt that the company is trying to produce a product which is better than the competitors. When you produce a product which is better than the competitors, you have two options: either to charge a premium price and improve profits, or charge a normal price and increase market share. You can end up charging a below premium price or the normal price. When you charge a normal price, what will happen is your market share will improve, but profitability will not improve. And if you charge a premium price, profitability is going to improve. So product differentiation is of higher quality and outperforms competition. Differentiation can come from quality product, timely delivery, wide variety of goods. So I said it could be price or quality, delivery, support. This quality, delivery, support, everything will come under the category of your differentiation advantage. Basically anything which enhances customer satisfaction from a point of view of other than price. Anything other than price which enhances customer satisfaction will come under the category of differentiation. You can help in charging higher price while retaining the market share, or charging a lower price to build a market share. The second strategy which we discussed about is a cost leadership strategy, where we have a relative cost advantage as compared to the competitor. What is relative cost advantages? You are able to produce a product at lower cost as compared to the competitor. Your product costing is lower than the competitor's cost. So when you are able to produce a product at a cost which is lower than the competitor, indirectly it gives you the flexibility to charge a lower price and improve market share, or charge a normal price and improve profitability of the company. Now why we discuss this again is, we are now going to link this with value chain analysis. What was value chain analysis is? The objective of doing a value chain analysis is to analyze the various activities of a company. The activities are broadly classified into primary activities and support activity. When you analyze the various activities of a company, you will be able to identify some of the non-value added activities and try to eliminate the non-value added activity. Now, the value chain analysis an organization can do in three ways. One is your internal cost analysis, second is internal differentiation analysis, and third is called vertical linkage analysis. Internal cost analysis is basically for a company which is following a cost leadership strategy. Internal differentiation is basically for a company which is following a differentiation strategy. Any idea what is vertical linkage? Any idea what is vertical linkage? Sorry? Linkage with the supplier. It could be a linkage with somebody. So you are the company. Before you there are certain players in the value chain. After you there are certain players in the value chain. For example, before me there is a supplier. After me there could be a distributor. Then there could be a retailer. Then finally the customer comes into scene. Or in between there could be a wholesaler. So lot of things, lot of people can be there. Vertical linkage is linking or analyzing how your value chain can be analyzed with the value chain of the people who are there. This is basically called as upstream value chain, and this is called downstream value chain. You learn this in a chapter called supply chain management. So you are going to analyze both the upstream activities and the downstream activities to see how you can get a competitive advantage. You can get a competitive advantage by having a better linkage with your supplier or by a better linkage with your distributor or retailer. It is essential to know what is the cost structure of these players, because unless you know the cost structure of these players, you will not be in a position to get the cost advantage or the differentiation advantage. In an internal cost analysis, what I am going to do is, I am going to look at the various activities an organization does, the critical activities which a company does, identify what proportion of the cost is incurred at every activity. The first activity 5% of the overall cost, second activity 25% of the overall cost, third activity 30% of the overall cost, fourth activity 10% of the overall cost, fifth activity 5%. So try to find out how much cost you are incurring at every activity, and the objective is to reduce those non-value added activities and do cost reduction for the critical activities as well. So your focus is to know the cost which you are incurring at every activity and then pulling down the cost side. Identify the value creating processes. Determine the proportion of the total cost of the product or the service. Proportion is basically percentage of the total cost. Identify the cost driver. Cost driver is basically why a cost is being incurred. We learned that there were two types of cost driver. What were those? Structural cost drivers and executional cost drivers. Identify the link between the processes. One thing which is very critical is, for example, we had inbound logistics, operations, outbound logistics, marketing and sales, service. We had support activity. I want to cut down on the cost. So what I did is, I have started recruiting people who are not that competent. I have started recruiting people in the human resource management process. We have started recruiting people who are not fully competent. Some issues are there with the employees, but you started recruiting because you wanted to cut down on the cost. But if you cut down cost on the human resource activity, there is a possibility that customer may become dissatisfied. There is a possibility that customer may become dissatisfied. So cutting down cost on one processes can have issue with some other processes. So you will have to be very clear on the linkage. Example, compromise in quality of raw material can increase service cost. If you try to compromise on the quality on the procurement side, be ready to listen to your customers' issues, because customers will keep coming back to you, and find out opportunities to reduce the cost for relative cost advantage. Same as internal differentiation analysis, but the focus is you are analyzing which activities are likely to give you a differentiation advantage. For example, for some company, the cost advantage, the differentiation advantage can come from procurement activity. They are able to procure wide variety of goods. You go to a supermarket. Why do you go to the supermarket? Is he is able to provide you a wide variety of goods. For some other company, the advantage, the same supermarket, the advantage may come from the service activity. They are able to quickly provide service to the customer. So when you go to that shop, they are able to quickly bill you, they are able to provide a free home delivery. So your advantage can come from any of the activities of a company. What value chain is saying is, look at those activities, see where the advantage benefit comes, and find out what are the ways to sustain that advantage, because differentiation advantage is very critical. Sustaining that can become a challenge. Identify the value creating processes, evaluate differentiation strategy for enhancing customer value. The differentiation can come from superior product features, this is basically from your manufacturing side. Effective marketing and distribution, this is from your sales and marketing side. Excellent customer service, this is from your service side. Superior brand image, this is I think all things working together. Better quality product at competitive prices will work on your procurement side, will work on your inbound logistics. So you will have to find out ways of sustaining this advantage. Then the last part is your vertical linkage analysis. In vertical linkage analysis, I said you cannot work in isolation. You cannot say that, for example, Bharadwaj Institute cannot work in isolation. We are dependent on few people who are above us in the value chain. We are also dependent on few people who are below us in the value chain. We are directly dealing with the students, so maybe in between layer is not there, but many companies don't directly deal with their customers. There is an in between layer which is going to be there. The layer could be a distributor, the layer could be a wholesaler, the layer could be a retailer. You will have to ensure that how can you link your value chain with them, so that you are able to provide that advantage, or you are able to get that advantage and sustain it. Competitive advantage not only comes from internal activity, but also through a linkage of a value chain with that of a supplier or user. User is basically the customer. The customer for a company could be, a retailer or a distributor as well. It includes all upstream and downstream activity. Upstream is above you in the value chain, downstream is below you in the value chain. We need to have a better understanding of the cost or revenues of each process, and this can be achieved by performing a vertical linkage analysis. I think we are almost done. There are just two more concepts I need to discuss. One is vision, mission and objective, and the second concept which is pending is service value chain, which we had discussed sometimes when we did value chain, but I said I will discuss it later. Now coming to vision, mission and objective, you could have come across this earlier. Any idea what is vision and what is mission of a company? What is vision and what is mission?
Vision tells us where are we going.
Okay, where do you want to reach? Okay.
Mission tells us what we are, what are we doing.
Okay, where do you want to reach? I think broadly this is the definition. Mission, what are we doing? So an organization will have a vision statement that will tell where they want to reach. It could be after 10 years or after 15 years or after 20 years, 25 years, they will have an objective. Mission is going to exactly tell what an organization is doing currently. Mission statements can undergo changes also as organization makes newer activities, enters into newer activity. Your mission statement can undergo changes. What mostly an organization does is, based on your vision and mission, there are goals and objectives an organization decides. Goals and objectives an organization decide. This could be a short term goals which will have. For each of this there will be a strategy. Organization will develop a strategy for each of this, and for the objectives and goals you may have CSF, KPI. CSF is critical success factors, KPI is key performance indicator. So Bharadwaj Institute wants to become the market leader. If I want to become the market leader, that's I want to be most okay, my vision statement can say I want to be the most student friendly institute in this in Chennai. That could be my vision statement. Mission is what we are currently doing. My objective is I am going to define this, how am I going to become the most student friendly company. So my objective is customer satisfaction. This customer satisfaction can be measured through a customer satisfaction score. I will get a score from you. Based on the score I am going to measure it. I can also measure it through percentage of students who repeat the classes from inter to final. So whoever comes from inter to us, how many students are repeating their classes with final, that also indicates what kind of customer satisfaction is there. Now just give me a minute. vision, we should dominate the market. From the vision, a strategy will come. The strategy could be cost efficiency, investment in new technology, or high quality. The image may not be that clear. There are different perspectives. These perspectives is something you will learn later. This is not exactly for this chapter, but I just wanted to show you something. This perspective will come in an area called as balance scorecard. There are different perspectives an organization will focus. For every perspective, there will be a critical success factor and there will be a KPI. KPI is something which is measurable. What is critical success factor is, I want student satisfaction. Now, student satisfaction is something I cannot just say that students are very happy randomly. I need some measure to manage that. So, KPI is something which is measurable. CSF will say we focus on good quality. Okay, great. Now, how do I say whether you are focusing on good quality or not? So, percentage of rejection. If there are less rejections, it means the products are of good quality. So, that is how we measure this. You can just read this. These are vision statement and mission statement of the companies which you will be able to relate. Most of them you should be able to relate. Nothing much for me to do. You can just read through these. Just give me a minute. I'll paste the vision and mission together. So, the first one is vision, the second one is mission, so that you understand the difference. Tesla, which is your car maker, to accelerate the world's transition to sustainable energy, that's their vision statement. To create the most compelling car company by dividing the world's transition to electrical vehicles. So, this is what they are currently doing. Their vision is they want organizations or the world to move towards a sustainable energy. Again, the second one you should be able to relate. Bring inspiration and innovation to every athlete in the world. If you have a body, you are an athlete. Nike, then their mission statement. Warby Parker is an optical company. Yeah, so you quickly read them. Vision will basically tell where they want to reach. Some of them could have reached that stage or they could be closer. For example, Google, to provide information to the world's information in one click. More or less they are closer to it. They do provide all possible information. And what currently they are doing is organizing the world's information in an universally accessible form. Amazon, we strive to offer our customer lowest possible prices, best available selection and utmost convenience. This is what they are currently doing. Their vision statement say to be Earth's most customer centric company. I think this is one great statement, to create a better everyday life for the many people. IKEA's basic vision statement is very simple. They want to create a better everyday life for many people. Now, this may not clearly tell exactly what they are currently doing, but their vision statement is very clear. They want to create a better life, and in their mission they will say what they are currently doing. Offer a wide range of well designed functional home furnishing product at prices so low that many people as possible will be able to afford them. So, they want to provide a wide variety of functional home furnishing products at a lower price. Price also they want to play, and also they want to provide good products. Many organizations, see, there are certain benefits of a vision and a mission statement. The benefits is it provides basically clarity to an organization. The mission statement many a times will provide clarity to the people who are working in the company. It also provides clarity to the customers. The customers will feel that this is more of an environment friendly company, employee friendly company, it focuses on sustainable strategy, it focuses on ensuring that it focuses on customer satisfaction, employee satisfaction, society satisfaction. The mission and vision statement can clearly indicate what an organization wants to achieve. So because of this, whenever there is some conflict, for example, they are not very sure what needs to be done, the mission statement may guide them, and also it helps in marketing. It also helps in marketing for the company. Let's look at in few case study. Before that, just one more thing, which is your last part, which is your value shop model. I had not discussed value shop model earlier. We had discussed value chain. Value chain is mostly for which companies? Manufacturing companies. Value shop model is also known as service value chain. The other name for this is service value chain. In a service industry, there is no manufacturing which happens. So your value addition, the value addition does not happen based on the product which is being provided to the customer. So primary activities like inbound logistics, operations, outbound logistics, marketing and sales, and service do not play a big part. In a service industry, the primary objective is basically to solve customer problem. Your primary activities are based on solving customer problems. Secondary are support activities, same as what you saw earlier. What were the support activities there? Procurement, infrastructure, technology, HR, they remain same. But your primary activity, the focus on the primary activity is on solving customer problems and not on providing a product, So for solving a customer problem, the primary activities are classified in a manner that you identify what the problem is, look at what are the solutions which can be implemented, identify what problem a customer has, look at what solutions can be implemented, look at which solution you want to implement, and basically have a review and control mechanism. Review and control mechanism is basically have a continuous check on what you have implemented. Serve companies from service sector. This was best applied to telecommunication and insurance and banks. These were the areas where this was applied initially, but now it gets applied to most of the industries, most of the service industry. Focus is to solve customer problems rather than creating value. Problem finding and acquisition, understanding what problem the customer has, look at what are the different solutions which are there, choosing among the solution, and finally have a review and control mechanism. Execution and control mechanism. Review and control mechanism is basically having a continuous check on whether you are able to achieve the desired result or not. With this, I am kind of done with chapter 1 discussion. We initially started